what we're going to be going over here is the effective interest method versus straight line bond amortization. And for example here, Corporation A purchases a 9%, that's the stated rate of interest on the bonds, and that's for $300,000. That's the maturity value of the bonds, and they mature in 3 years, and they pay interest semi-annually. Now they were purchased at 102 3/4 or 102.75% of par, so they were purchased at a premium here. So the company would have had to pay more here for the bond when they bought it than what they're going to receive here at maturity of $300,000. Now the bond's stated rate of interest here is 9% annually, and this is given here, but the yield rate of interest for this example here is not given, and that's what we're going to have to calculate here when we're using the effective interest method here to amortize the bond. Okay, so let's first start out with our straight line bond amortization here. Now in both cases here, for straight line and the effective interest method, we have to set up our amortization schedule here. So let's look at it here, and we'll start out with the cash that we're going to receive here for those semi-annual interest payments. So we have a 9% interest rate per year. Divide that by 2, so you're going to get a 4.5% interest rate here semi-annually here. So you got 3 years here on the bonds, 2 semi-annual payments, so you're going to have 6 total payments here receipt. So then here for our cash payments, you take the par value, or the $300,000 worth of the bonds here, times that 4.5% semi-annually, and you're going to get $13,500. Now that's based on our cash receipts here. Those are what we're going to receive here, each of those next periods here, semi-annual payment periods here, for 6 periods or 6 semi-annual payments here. Okay, so we've got that's our cash received here. So now let's go over and look at, we'll have to work with a carrying amount of the bond here. This is where we start out with the what we paid for it here, that 300. Well, let's go up and calculate that here. If we didn't, the bonds were purchased at 102 3/4% here. Take that times the $300,000 here, so you're going to get $308,250. I think we calculated that, but if we didn't, that's what we paid for it, and that's what we start out with here, and we have to amortize that down to its maturity value here of $300,000, and that's over the 6 periods. Okay, so next thing we have to do with this straight line method, we can go and we can determine the exact amount here that we have to amortize. In this case, it's that premium, and we amortize it evenly over those 6 periods that we're looking at. So simply take your $308,250, that's your present value here, what you start with, and you amortize it down to $300,000. So the difference gives us $8,250 over 6 periods. Divide that out here, $8,250 by 6 periods here, you're going to get $1,375 per period. So that's the amortized premium that we're going to be looking at. So the interest revenue here, that's what we recognize on our income statement. We have cash receipts here of $13,500 each semi-annual payment, but we also have what we have to look at on our income statement here. That's the actual interest revenue that we'd be recognizing here, and that's simply taking the difference here. We got the amortized premium here of $1,375. Subtract that here from the cash receipts of $13,500. That gives us the interest revenue of $12,125. That's what we recognize evenly over each of those 6 periods. So first, you can see what we had to do here. We had to first amortize our premium evenly over those 6 periods, and knowing that, and then knowing our cash receipts, then we could determine our interest revenue. Okay, so that takes care of our straight line bond amortization. Now let's go over to our effective interest bond amortization. So this is the case here where, had we been given the yield rate here, we're going to be, first off, we're going to be dealing with the same amortization schedule. We're going to have our cash receipts. Actually, those are going to be the same as that we had for our straight line, for example. It was that 9% per year here, over semi-annually is 4.5% here per period, times that $300,000 bonds that we have here. That's the $13,500. Received here, each of those 6 periods. Same as for the straight line amortization. But what we're going to have to do here, we're going to be working, we'll go over to our carrying amount here. We're going to have the same, we're going to be dealing with the same numbers here. The $308,250, that's what we paid for those bonds based on that 102.75% here that we had to pay for those bonds. And we have to amortize it down here to $300,000. Same as the straight line here. But how we set up this, our premium, our amortizing our premium here, and the interest revenue that we recognize, that therein lies the difference here. So what we have to do is we have to determine the effective interest rate, or the yield rate on this bond here, since it wasn't given to us. So the only way we can really do that effectively here is you plug it into, we'd have to use a financial calculator or Excel or some means of determining that interest rate. And I'm just going to use the calculator here. And this is where we're going to be matching our interest rate to our periods here. So what we have to do is, we have the calculator here. You're going to have these functions on it. You're going to have the number of periods, your interest rate in the present value of the payments here, and the future value. And you got to enter the amounts correctly here. So let's say, take your calculator here. The number of periods that we're talking about, those were 6 periods here because they're semi-annually here. And our interest rate, that's what the calculator is going to determine for us. But we have to take our present value here. That was the $308,250 here. And you enter that as a negative amount here on your calculator. That was what we had here. That was at that premium, 102.75 here, times the $300,000 worth of those bonds, $308,250. So that goes in as a negative amount. Now, the payment amount, that's what we're going to receive here each period. That was that $13,500 here, our cash receipts here for the period. And then the future value, that was what the maturity value of the bond here, $300,000. So enter all those in, hit your interest button on your calculator, and you're going to get your yield here. And I've got it worked out here to 4 decimal points. That's why you have to use the calculator here. 3.97528%. That's semi-annually here, because that's what we put into our calculator. Everything was based on those semi-annual payments. That was the N, the number 6 here, and then the payment amount here, that was semi-annually. Now our present value here, that is whatever we paid for it here, and the future value, that's whatever we're going to receive for it on those bonds in the future. So what you have to match here in your calculator is the number of periods here with that payment amount. And then that gives you your percentage yield here, or effective interest rate here. And how you would amortize that here is just simply taking, well, our amortization schedule, the same as our straight line here, is as far as setting up our carrying amount here. We start out with $308,250. We amortize it down to the maturity value here of $300,000. And then our cash receipts, those are the constants, same as straight line here, $13,500 each period here for those 6 semi-annual payments. But our interest revenue, this is how we go about calculating that. We take that effective interest rate here, 3.97528%. We take it times the beginning carrying value. In this case, say it's $308,250, and that is going to give us our interest revenue for the period here of $12,255. Now, we would just compare that to our cash receipts here of $13,500, and the difference here is going to give us $1,245. That's the amortization here for that first period, that first semi-annual interest payment. Subtract that here from your beginning balance of $308,250. You get your new carrying amount here for the next period of $307,005. And then just proceed on using this effective interest rate here times your new carrying amount. That's going to give you your interest revenue that you have for the next period here. Compare that to the cash amount here, and that's going to give your amortized premium. And just continue on. Take and subtract that amortized premium for the period from your beginning carrying amount, and you get your new carrying amount, and then just continue on amortizing it down here. But with the effective interest method, what we had to do is if we were given the yield rate in the problem, then we could go directly to that and use that yield rate, whatever it was. If it was on an annual basis, since we have semi-annual payments here, we'd have to divide it by 2, and then we would be taking that again, same as we did here again against our beginning carrying amount, and that would give us the interest revenue. But since we were not given that in our problem here, then we had to go and we have to use some type of function, either in Excel or on your calculator. There's several ways of doing it on your calculator here, but we'd had to determine that interest rate on for the semi-annual basis here. So that's what we did here with our calculator here. So after we only way we could determine that was by again using these functions here. N for the number of periods, putting in the present value, and then again put that in as a negative amount here, and then we had to determine what our interest payments, receipts in this case, were on a semi-annual basis. We knew what our future value or our maturity value was, then we could determine our interest rate here. But with the straight line method, remember, our amortized premium came off, just taking our carrying amount here, compare that to the maturity value here, divide that evenly out, and you're going to get the amortization per period here. And then based on that, in our cash receipts, we could determine our interest revenue. But now, with this effective interest rate method, we had to first go and we had to calculate the, in this case, that effective yield rate here, effective interest rate here, and then we had to take it times our carrying amount here to determine the interest revenue here. So we have to sort of work in a little bit in reverse here when we use the effective interest rate method versus the straight line method. So you can see with the effective interest rate method here, what do we have? We have an increasing amount of premium each period here, and we have a decreasing amount of interest revenue here that you can see here versus the straight line, where the straight line was just the same interest revenue over the period here and the same amortization of the premium. But in both cases, the cash receipts would have been the same here. And then between the two different methods, you can see your carrying amount varies here. It really depends on the amortization of the premium here. With the effective interest rate method, you can see your premium was being amortizing in a greater amount here than with the straight line. Therefore, your carrying amount would be reduced by a greater amount versus the straight line from period to period. Okay, so that's just a brief overview here using the straight line bond amortization versus the effective interest rate amortization.